We're making a video today talking about K-1 tax forms. I wanted to bring an enrolled agent here on the show. I'll let Karlton explain that. Karlton, welcome back to the show. It's great to have you here.
Yeah, absolutely. Grateful to be back. And I'm excited to go over the K-1. For many investors, it seems there's a lot of question marks when it comes to the K-1. So hopefully we can clear up some of those question marks today and give you guys a better idea of how investing in real estate can benefit you from a tax perspective. For the listeners out there, I'm actually a licensed enrolled agent, which pretty much means I have like a really high designation with the IRS to practice tax laws in all 50 states. So I primarily do tax strategy, which is helping investors and business owners leverage the tax code to the fullest extent to pay the least amount of taxes possible. I also run a tax and accounting company where I have over 20 CPAs who file returns and do bookkeeping and accounting services. So with today's training, my goal is to simplify something that seems very complex, which is understanding how real estate losses can really impact you on a K-1, making sure that you understand where they are and what you can do to leverage them if you're somebody that's trying to build wealth in the real estate space.
I wanted to use a real K-1 example. I didn't want to talk about a bunch of theory. This is one of my actual K-1s. Didn't want to, disclose the deal, the operator, things like that. So blocked out sensitive information for obvious purposes. This is a value add multifamily private placement deal, or what some refer to as a syndication. I had invested $50,000 in 2019. We ended up selling it in 2021. So we're going to look at each of those years. And Karlton, I'll let you take it away. You're the expert here, and feel free to ask any questions as you go along.
Yeah, absolutely. So for those that are listening, this is Travis's 2019 K-1. And how we can know that is by looking at the center of this K-1. So this means that when the tax return gets filed, this is when we'll actually see this form come alive. Now, in order to understand what tax returns get filed, I'm just going to quickly jump to my iPad here just to share with you guys what a 1065 form looks like. So we file a 1065 tax return anytime we have partners. So if there's a partnership in place, a 1065 tax return has to be filed with the IRS. And this is really just an information return, which means that the IRS just wants to understand, what did the business do? And with the information return being filed, the 1065 will push out K-1 forms to all investors or all owners of that partnership. And so when you guys see today us looking at this K-1 form here, this is exactly what comes after a 1065 tax form is completed. The one thing that Travis wants you guys to understand is, where would we even know how much money that he contributed to this investment? Well, if you scroll down here underneath part number 2, we will learn more about the information of the partner. So when I look at the information of the partner, I can scroll down all the way to the bottom in section L. And in this section, it lets me know my partner's capital account analysis. This is going to let me know what the capital contributed to the year was. And in the year of 2019, he contributed $50,000 to this partnership. And the K-1 form was created because Travis decided to go into partnership and he contributed $50,000 of his own capital. And that's why we see this underneath beginning capital account. The next thing that we want to understand is, what would be his percentage, right? If he's going into a partnership, maybe there's going to be other partners. Is there a way for us to be able to determine his percentage based on his capital contribution? And we're actually able to identify that. Here in line number J, we can see what beginning and ending percentages are, whether it's based on profit, whether it's based on loss, or whether it's based on a capital contribution. So this is his percentage. We can see right here, 0.35% based off of the $50,000 that was contributed into this partnership. Now, let's make it very simple. How do we understand who owns the K-1? Well, now we go back up to part number 1. Under part number 1, you're going to have information about the partnership. Typically, you're going to have the partnership's employee identification number, which I'm sure Travis just wanted to make sure that that was blacked out for this meeting today. But you'll see the employee's EIN number. The partnership's EIN number is essentially the partnership's social security number, for lack of a better word, but it's truly how the partnership is identified. So the partnership is going to have its own name, the partnership's going to have its own address, city, state, and zip code that it's associated with. After we look at part number 1, part number 2 is where we get more information about the partner. So we know that Travis is the true partner of this partnership. And so underneath part number 2, if you're an investor, this is where your information would be. You would have the social security number or a taxpayer identification number if you don't currently have a social security number in the United States. You would also be able to place your name, address, city, state, and zip code here if you're a partner. Now, if you decide to invest as an LLC, this would also be where you would see this information as well. As you can see, this is a limited liability partnership. So the checkbox in part G is checked for limited partner or other LLC member. So this is an LLC managed partnership. Then in part number H2, I can identify if you are a disregarded entity. But what if he approached this partnership with a retirement plan, such as like an IRA or a SEP or a KIOG plan, right? These are all different various vehicles. So if he approached this partnership with a retirement plan, I would be able to see that in line 12 right here. If the partner is a retirement plan, IRA, SEP, KIOG, etc., check this box. But down here, we're going to start to look at something that's really interesting. Travis contributed $50,000 in the year of 2019, but he received a current net income of negative $29,579. So you might be wondering, what contributed to this negative $29,579? And here's what I want you to understand. It's also present over here on the right side of the page at the top. Part number 3, partner's share of current year income, deductions, credits, and other items. One of the many benefits of investing in real estate is that we get a lot of real estate tax deductions. But one of the most powerful tax deductions is the depreciation. And the depreciation is taken on the entire building's value that Travis and other members have decided to purchase through this partnership. Line number 1 tells me ordinary business income or loss. But you guys know, if you're investing in real estate, that it's not considered ordinary business income, it's considered rental real estate income. So although Travis contributed $50,000 to this investment, right now he's reporting to the IRS that he's making negative $29,579 in a rental real estate loss. And this is really coming from depreciation. But this is interesting. If we're going to invest into a real estate deal, aren't we investing to get cash flow? Aren't we investing to make sure that we can build wealth? So what we're going to do is we're going to figure out, how does this real estate loss impact his ability to grow wealth? And is he receiving distributions from this partnership that he has decided to invest 50 grand in? Now, there's other ways for us to have income inside of a partnership. Maybe we can have interest income. Maybe we can have ordinary dividends. Maybe we can even have qualified dividends. But all of these different forms of income that can come from the partnership needs to be tracked. And this is how the IRS tracks your income when you decide to file a 1065 tax return. And then you'll also see here is if you ever sell real estate or sell assets, that you might also be subject to short-term capital gains or long-term capital gains based on how long you held on to the asset. Underneath this item, unrecaptured section 1250 gain, which is pretty much depreciation you did not accelerate on a property that you're selling and regaining. Section 1231 gain, which is like capital gains on a property, the actual gain on a property when you sell it, and other income or losses. Distributions lets us know what are we actually receiving from this partnership in the form of a distribution of cash or credit that could be taxable income to us. In this year of 2019, he received distributions of $1,833. But what I want you to understand is there's a net rental real estate income loss of $29,579. What this means is that this loss, being on the same form as this distribution, is counted as a deduction against the income that we just added up. As we jump over to 2020, you'll notice that we see distributions have increased and that his losses will continue to travel forward with him. Now, here is in 2021. We're now seeing a distribution of $72,315. So let's ask Travis what happened in 2021.
Yeah, so 2021 is when the partnership dissolved and we sold the property.
Yep, and we can definitely see those gains here, right? Because we have the unrecaptured section 1250 gain, and then we have the net section 1231 gain, which is his total gain from his capital contribution and his cash flow coming back to him. Unrecaptured section 1250 gain is subject to 25% flat tax rate. Section 1231 gain is your true gain on the property, subject to long-term capital gains rates.
You did a tremendous job, man. I appreciate, all the visuals. Can folks reach out to you if they have any additional questions or want to learn more about you and your business?
Yeah, absolutely. So we're on all social media platforms. You'll probably run into me on YouTube. We have a growing YouTube channel. I think we're well over 500,000. So feel free to hit the subscribe button. If you guys are looking for any tax services, you can reach out to our tax and accounting company, KDA. We have well over 40 individuals at that firm that'd be more than happy to assist you on any tax strategies as it pertains to your investments. And if you have any questions, if you'd like to reach out and just ping me, you're more than welcome to reach out on Instagram. I'd be happy to get in contact with you.
Thanks so much. You're listening to Masters of Multifamily, and we'll see you in the next episode. Take care, everyone.